What's going on, guys? My name's Taylor.
And I'm Ryan. If you're new to our channel, we're here to help you make the right choice with your money.
Now, we each have college degrees in engineering. We've been studying investing and finance for a couple years and each have some experience in the real estate game. I'm working towards my license right now. We're just guys really looking to reach financial freedom quicker than most people, I guess you would say. And I hope you guys can join us on our journey.
And in today's video, we're going to talk a little bit about where we'd recommend you put your money. So when you start making a little bit of money, or right before you, even if you're in college and you're just trying to get started, and you know it's all about time and how long your money sits in a good account, or how long it's with real estate, your money will grow. It's a big thing to get started early. So where we recommend putting your money to start and all the way down the steps. So we recommend taking 15% of your take-home pay, your take-home income, and putting that towards investments. So if you're making $100,000 a year, you're not taking 15% of that. You're taking 15% of after taxes income and putting that towards all your investments you do in this step-by-step order. First step we're going to recommend is not necessarily an investment, but what we would say is an emergency fund. You always want to have yourself backed up before, just in case, because they say with investments, how much money are you willing to lose just in case something went wrong? And if you did lose that money, at least you'd still have your emergency fund. We've talked a lot about emergency funds on this channel. We're very big about them, saving your own butt, obviously. We recommend 3 to 6 months. It all depends on your risk level at that point. If you don't have many expenses, 3 months might not be bad if you can definitely handle that. We recommend with an emergency fund, you want it very liquid. You want to be able to get it very easily, have access to it. So a good one we both use is just going to be in your typical bank is going to have a money market. A money market helps you edge inflation just a little bit better than any other old savings account, and it's still very liquid, accessible money. So that is going to be our recommendation of where you should hold that emergency fund, because again, you want access to it year round, every day. So that's going to be big.
Yeah, and there are some contingencies on you getting these higher interest rates than you would in a normal savings account. You do need to maintain a balance over $1,000. Of course, your bank may have certain qualifications or whatnot, but that's a typical rule, so you will need to kind of meet that requirement. But the next step we'd be looking at, and this is very important that a lot of people skip until they're much older, but it's better to get in early, is a form of a retirement account. Our next video, we're going to go in depth, like real in depth, into the 4 most common retirement accounts that you'll see, which is like a traditional 401k, Roth 401k, traditional IRA, and Roth IRA. And there's differences in how it's taxed and all this stuff, but we'll get into that in the next video. But if your company offers a 401k and they offer any form of matching, put money into that 401k, because that company matches just free money and you should take full advantage of that. A lot of them will, match up to a certain percent of your income, and you should put in that max percent if you can afford it, because all of that's just free money that you're getting.
Yeah, exactly. And like you said, in our next video, we'll go over all of that, all the differences. We'll have a little example for you guys. So if you are interested in that, definitely stay tuned. And at the end of this video, we'll also have a extra step that not a lot of people know about. So stay tuned for that. But rolling into our third step, we're going to talk about the Roth IRA. So after you've got your emergency fund set up, after you've done the 401k match, you're going to want to fully fund your Roth IRA. The big reason for that is going to be because your Roth is after tax income, so it's going to grow tax-free, and that's huge. And again, if you want to know more about your Roth IRA and why it's such a big deal, and why most people should max that out as soon as possible, we'll show you those projections in the next video and how you can become a millionaire super easy on a Roth IRA.
Yeah, and another thing we should probably mention, and we'll get in more into this in the next video, obviously, but a 401k will have to be established by your employer. So if you don't have one that offers a 401k or anything like that, you can skip that step and go into your Roth IRA and invest heavily in that until you get to a point where you have a 401k available. Yeah, guys, and for the next step, the 4th step, it's a bit more of an interesting one. A lot of people seem to have more fun with it because it has more options available. It is higher risk, though. Traditionally, it's investing in the stock market. Now, depending on your risk level, will play a large factor in how you kind of invest and deal with the stock market. If you're single, young, no kids and everything, not a lot of commitment, you can afford a lot more risk. But further down the line, when you're starting getting older, 35 plus, which I know isn't that old, but it's just things commitments tend to start up more, and you got to take things more seriously at this point, typically. So you can start looking into investing in that. We're gonna have a whole nother video on kind of the basics of things you should look at, how to pick some stocks and all that. We'll go really into the depth because the stock market is a beast. Okay, if we talked about it in this video with all the other stuff, this video would be crazy long, but we'll break it down further into how you can kind of approach that. But this is something that you should do after you get these retirement accounts and everything prior to this handled.
And just like Taylor said, the stock market is a high risk level, so we definitely don't recommend diving in the stock market and putting all your 15% in that. No, there's no reason for that. You want to have safe assets. You want to have things will grow. And then after that, people really do care about their money. So wherever you decide to put your money, you're going to pay a lot of attention to. So if you go and throw it in the stock market, you're going to learn a lot about the stock market by just watching what your money does and where you put your money. That's exactly how we've learned everything we've learned. We just put a small amount, very small percentage of our investment fund into the stock market just to learn as much as we've learned, because we knew we'd learn the fastest that way. Our final step we're going to talk about is kind of an optional or alternate step. This isn't for everyone. You'll see, because there's a lot of restrictions to it. But an HSA account, a health savings account, is huge. It's not very talked about. It's not always heard of. Even an employer, they'll put it at like the bottom of the page. It's just something random they'll throw in there. They might not even 100% know. But if you do your research, it is a fantastic investment opportunity. So basically, an HSA is going to be money taken out of your check, put it straight into this account for you to save for health-related expenses. The health-related expenses, if you use this account and charge, they give you a little like debit card for it. If you charge the card towards health related or approved expenses, it's free. Like you don't get taxed on that money, which is a big deal. And if you hold that account and you keep the money in there long enough till you retire at 65, you can actually use that as a retirement account, tax free. And again, that's insane. Just putting away money to save for health related incidences or health related things and then turn it into an investment account is crazy to hear or think about. But when I say health related, you don't have to go in for a big procedure. You don't have to have kidney stones removed. It's small things. If you go to the store, and I think if you get tampons or condoms, that counts. And you can just swipe your card. Obviously, you can hold out on doing that as much as possible, because then obviously your account grows more. And then once you get over an $1,000 limit in that account, you can actually invest everything over that. So as long as you have at least $1,000 that sits in that account that's accessible to charge, the rest of it is investable, which is a big deal. Again, if you invest in the right things and it blows up or it does really well, you can have a very good retirement account or second retirement account or third or fourth retirement account if you follow all these steps. Like, you can really grow rich, become a millionaire very fast this way by investing, and then you just forget about it and eventually it keeps growing and growing for you. Now we talk about the things that are going to limit you from being in this situation. So first of all, when you sign up for your company health plan, you have to be in a high deductible plan. That is the only way to have a health savings account. If you're on Medicare or you have any other type of plan, you can't also open a health savings account. So that is going to be one restriction for a lot of people. The last thing that is going to restrict a lot of people, especially if you're younger, is if you are claimed as a dependent on your taxes, you also cannot open a health savings account. So those are the three big things, the three big reasons why people can't open a health savings account, but there's really no reason why most people don't hear of a health savings account. I didn't hear about it until I started at my company, and I looked heavily into all the benefits, tried to take advantage of everything I could, and I'm like, what is this health savings account? I did my own research, and of course I signed up after seeing all the great benefits. If you guys have more questions about health savings account, or you guys want us to make a more in-depth video, we definitely can do that. Please leave a comment in the video. Please let us know what you're interested in. And if we can give you guys more feedback or maybe a good example, and again, kind of like the Roth or the 401k we're going to show in the next video, we can do a projection of how this health savings account can do wonders for you.
Yeah, and I think just another thing that he touched on, a lot of times when a lot of younger people hear anything related to health, they kind of shut down. They're like, us being young and everything, people typically think, like, we know that we're not invincible, but people seem to perceive themselves as less susceptible to all these certain things, which to an extent is true. But you never know what'll happen. And like Ryan was talking about, you'd be surprised what can qualify for these eligible payments through this account and everything. It's just a great opportunity that we do encourage you to look into. Don't just kind of shut it off because we premised it as an alternative account and everything. It's a great thing. You just don't hear a lot about it.
Yeah, and to Taylor's point, the health savings account, I keep beating the dead horse about it being a retirement account and turning it a retirement account. But again, if you are have a problem or in the future where you do have to go in for a procedure you just weren't expecting, okay, maybe the account's not as high, but now you've saved for that. That's a big deal.
Yeah.
So forget the small charges at CVS. You have this lump sum of money that you've set aside for a procedure, so you don't have to get a loan to afford it, or you don't have to do anything crazy like that. You don't have to go into debt for a procedure because you saved for it, and off that good news that you don't have any of these problems in the future, now you just have a big savings account or a big retirement account. But to close out, we really appreciate you guys watching these videos. If you guys can like and subscribe, please leave comments. We really want to hear you guys' feedback on our videos, future videos, or just let us know you watched it. Leave a comment, let us know. We're excited to get in touch with you guys, talk to you guys. Thanks, guys.
Yeah, and be sure to check out our next video. We will go further in depth into all those retirement accounts. Super important. There's a lot of qualifications and contingencies and max contribution rules. There's a lot of rules into investing and everything. So we'll go in depth into that, cover what you need to know. Make sure to check that out. Thanks, guys.